When most of us hear the phrase, "but this time it's different," we roll our eyes because we've heard that time and time again. If anything's the same, it's that phrase every time it's used. But this bull run that we're seeing with gold is different, and it is bucking the trends. And we're going to talk about that in this video as we explore. There's a great piece by the CEO of Metals Daily, Ross Norman, that outlines what gold is doing that really exposes some serious failures in the gold market itself. And it is unique. Could this essentially be a situation like what we saw in 1980 and 2011? Well, maybe, but we don't want to go there quite yet because this rally has been sustained. The famous German dramatist Gottfried Lessing once observed that in nature, everything is connected. Everything is interwoven. Everything changes with everything. Everything merges from one into another. This observation more than ever applies to the current gold market, one that is anything but conventional and yet still interlinked. While gold has long been a subject of intrigue for investors, its current rally is nothing short of perplexing. And that perplexion is, if that's such a word, is something that we'll witness some dips in the market. And I'll get to that later in the video too. But even as such, more likely we're going to keep prices fairly close to where they are through the year, I think. And so does the author here. This is why I like Summit Metals, because they have gold. And you're going to pay lower premiums there than many other dealers. So check out summitmetals.com. Gold has always been driven by a complex web of economic, geopolitical, and market forces, but is perhaps best described as being the sum of all fears. Fear does drive the market, that's for sure. However, the dynamics that are typically at play are now behaving unpredictably. This makes the gold market an especially difficult one to understand at the moment. For starters, the ongoing bull run in gold seems to be ignoring many of the traditional correlations, leaving analysts to question why. And I tell you what, it's interesting because as this bull run has started, I've actually been right about my predictions on where gold has gone over the last 4 years. And, 5 now. It's already surpassed my prediction of $2,900 an ounce. The gold has traditionally been seen as a hedge against inflation. As inflation rises, gold prices tend to follow. And although this pattern holds in the long term, over the short term, it is behaving unexpectedly. In 2024, with inflation rates in the West declining fast, gold has bucked this trend, accelerating rather than slowing down as one might expect. Historically, gold has also held a strong inverse relationship with the United States dollar. When the dollar strengthens, gold tends to weaken. Yet in 2024, both the US dollar and gold have risen together, an unusual alignment that defies historic norms. I've actually pointed that out in several of my market reports. Further complicating the picture is gold's strong relationship with U.S. Treasury bond yields. As a non-interest-bearing asset, gold typically falls when bond yields rise, as investors turn to more profitable fixed income assets. Yet last year, gold and bond yields have been moving in parallel, suggesting that traditional relationships are being disregarded. In short, gold has decoupled from almost every expected norm. Even the performance of silver, often seen as a leading indicator within the precious metals market, foretelling a pivot in the metals complex, that relationship has also differed from expectations. However, I disagree with him on that. Gold is a leading indicator. Silver follows, or outperforms, or underperforms. Historically, silver tends to outperform gold during bullish periods in the precious metals sector. However, the gold-to-silver ratio has surged, indicating that silver is underperforming and being largely bypassed in this rally. It is the dog that did not bark. However, there is a reason for that, and we're going to see what he's got to say because I can tell you what's going on here. Meanwhile, gold demand from Asia, especially for jewelry, has remained surprisingly strong. Despite rising prices, which is also counter to expectations. But keep in mind, Asia has also been importing a lot more silver because of these high prices, but demand is still there. Asian buyers are traditionally highly sensitive to price changes, especially as jewelry items incur very thin margins and there is little scope to absorb price increases. But this time they have remained active participants even as gold prices have reached an all-time high in domestic terms. There are exceptions to that, by the way. So, if the traditional drivers of gold price are not in play, what is? Three main possibilities are considered here to explain the current market behavior. One theory suggests that gold is no longer correlated with other assets in the way we thought after centuries of reliable and predictable behavior. Another theory is that we are witnessing a paradigm shift in the gold market, which is less driven by Western economic considerations. He's on to something there. The third, and perhaps the most compelling theory, is that a large opaque player is behind the surge in demand. Someone whose purchases are a very high conviction and large enough to distort the market. Well, it's not very opaque, it's very transparent. Just ask the World Gold Council. More on that later. The first explanation, that gold is no longer correlated with other assets, seems unlikely. Historically, gold's price movements have been reliable, and it is hard to imagine that this long-standing relationship has suddenly disappeared. Just not now, at least. These correlations have a logical basis, although they can, as we can see now, be overridden temporarily. So now the second possibility, a paradigm shift. The market could be undergoing a transformation that has yet to be fully understood. I think we have an idea as to what's going on, though. Historically, price discovery process for the global spot market has centered on the London market, the crazy London market. Not only are the most bullion trades settled and cleared here, but it also vaults the largest proportion of the world's metal, much of it, by the way, going to the United States now. That said, China is both the largest gold producer and consumer, and it follows that perhaps the East is having an increasing effect on price discovery, and a little like a strong magnetic field. This would be to say that to understand gold, one would need to see it through the lens of the Asian investor, and less as a Westerner might. And certainly there are very powerful reasons just now why investors in the East would buy gold, and arguably less so in the West. For sure, many of the largest price moves have occurred during Asian trading hours, so the argument may have some validity. I think he might be onto something there. However, many analysts are leaning towards the third theory, that a large and unknown player is driving gold's recent rally. This would explain why gold's rise has seemed to cut across almost every traditional market correlation. Well, let's see here. Let's get into what he's talking about here, because I don't know that I'm buying it. The opaque buying spree. One of the most unusual aspects of the current gold market is a lack of transparency regarding who is buying. Typically, market data, such as import-export stats, vaulting data, and shipping rates, can provide clues about the sources of demand. But right now, there is very little statistical data available to explain who is behind the significant buying. And if you know who is buying, then you can understand much about its quality. Strong hands buying, central banks, or maybe short-term speculative plays. And by extension, to what extent the rally can be expected to prevail. Well, I think we've got it. The data is pretty transparent. And even if they're buying, if some of it's opaque, if we don't know who the buyer is, we don't know how much of it is moving in circles. But we know that there is record levels of gold being purchased year after year since 2022. And it is continuing into 2025. I think that is the biggest driver for gold's price that is bucking the trend, that exposes the serious failure in the overall market. And that's very transparent, according to actual stats from the World Gold Council. Now, are they complete? I don't think so. I think there's probably more gold buying than what's accounted for, such as many nations' sovereign wealth funds, which are not tracked by the World Gold Council, and that's quite possibly one of the market drivers too. But heck, the official gold buying through the central banks is a huge driver. So I don't think there's any more than that that's happening here. Although there may be some credence to this, is why gold has really stayed up there for a while. But anyways, there are relatively few high conviction buyers out there that can match the profile. Gold has scarcely paused for consolidation, let alone profit taking, for nearly 1 year now, as we have seen the price action ignore traditional headwinds. The buying appears to be highly concentrated, and the lack of visible telltales suggests that it's being driven by a single powerful entity whose identity remains a mystery, but their influence in the market is undeniable. Well, this is interesting because I don't know where he got this information about, leading to a single buyer, but there could be something to that. Like I said, the gold market is complex. I don't think it's as complex as the silver market, but there may be something to this. So there are two possible explanations for the 34% increase in gold in the last year. One opaque sector is the derivatives market. It is known that significant leverage long positions have been taken on the Shanghai Futures Exchange and most likely in the over-the-counter market. It fits the bill insofar as derivatives plays tend to be agnostic of border macro events. If sufficiently large, it can also bring out a self-fulfilling wish. If, say, a Chinese speculator buys a very large number of gold calls expecting prices to rise, then the bank on the other side of the trade would typically hedge by buying about half of the positions in the spot market, which is sufficiently large would cause the price to rise, prompting further hedging by the bank, creating essentially a feedback loop. The only place where this would be evident is spot purchases by the bank, who would buy gold, which would lead to more buying, pretty much what we're seeing now. But I still don't think it's enough to match the central bank buying, but I could be wrong. A second explanation would be a large undeclared central bank buying program, and that is, I think, a better possibility, but I think even declared is the case. With financial sanctions across the world running high, and with arguably the U.S. under the previous administration having weaponized the dollar and excluded a number of nations from international payment systems, it follows that prudent central banks who might fear a similar fate could sell dollar assets and acquire gold, as it has no counterparty risk, the de-dollarization, which is happening. In this environment, they would simply place purchase orders from the major refineries, and here arguably price is not especially important. So it does fit the profile. Either or possibly both scenarios are at play just now. If you can tell something of the character of a man from how he behaves under adversity, then so it is for metals. And the character gold is displaying just now is an unusually insensitive approach to broad economic events and relentless buying. And that's where he gets into the calls for this year, which actually were above the average. They're saying at the beginning of each year, the London Bullion Market Association asked the market analysts to forecast the gold price outlook for the year ahead. They expect a high of $3,175 and an average gold price of $2,898 in 2025. Much as in the 1970s, we expect to see a second inflationary echo or spike as global economies recover. And while economic prospects in the U.S. may brighten under the pro-growth Trump administration, it will likely remain in a highly uncertain world in short-term policy shifts. So we'll see how this plays out, but it is interesting. So interesting analysis there. I agree with some of it, but I think that essentially what's driving this that is unique is the official numbers from the World Gold Council and gold buying from nations. I think the IMF as well. But there very well could be other buyers or other buying occurring as well. Let me know what your thoughts are down in the comment section below. Hope you found this video informative, insightful, and educational. Would like to extend a multitude of gratitude to each and every one of you for taking the time to watch. and to encourage you to please rate, share, comment, and subscribe.